Thank you very much for joining us today. To those of us who are viewing our conversation, welcome. My name is J. Paul Massey Singh. I'm the CEO at the Brampton Board of Trade, and on behalf of myself and the team here, welcome to our expert series. This is our online series of conversations with highly qualified experts in their fields, where they share actionable insights and experiences to help you make better strategic decisions and grow your business. Today, we're excited to be joined by the bright minds at Generation PMCA for Outlook Post-Monetary Tightening Cycle, a discussion on the impacts of recent monetary policy changes on investment strategies and on portfolio management. Generation is a team of portfolio managers and capital advisors dedicated to helping clients achieve their goals through world-class equity, income, and investment strategies. With us today are three very knowledgeable panelists, all from Generation PMCA. Jai Prasad, Vice President of Generation and a capital advisor, Badar Shamim, Vice President at Generation and a portfolio manager, and RJ Steinhoff, Head of Research and a portfolio manager. They'll be discussing how they are positioning clients' portfolios to navigate current economic trends, as well as examining the potential for fixed income portfolios to benefit from lower borrowing costs and interest rates. Finally, they'll be offering guidance on how to tailor for BBOT members on how to best tailor their investment strategies and investment planning in these uncertain times. Of course, conversations like this would not be possible without the support of our great sponsors. And on that note, I'd like to thank PDC, Barristers and Solicitors, for helping make today happen. And with that said, I know everyone's here to listen to you, not me. Badar, how about I hand it over to you to lead off the conversation?
Jean-Paul, first off, I want to thank you and the rest of the team at Brampton Board of Trade for giving us the opportunity to have a heart-to-heart with your members. Generation PMCA is a 24-year-old family-owned investment management firm. We really have two businesses, portfolio management side, where we not only manage our principals' capital, but also help other Canadian and American families manage their assets. So we're unique in that sense that we're registered with both regulators here in Ontario as well as across the border in U.S. To be able to act as their investment advisors. And we also have a business called Capital Advisory Business, which is an IROC registered business through which we help companies raise capital. So today we will start off with our Director of Research, RJ Steinhoff, sharing our broader outlook. A lot of your members face these situations on a day-to-day basis, and you might be hearing some of this through them as well, but it will confirm what we're basically saying from an economic perspective and how we're positioning our clients' assets, both from an investment management perspective and how we're helping our clients with the capital advisory side in terms of being able to access capital under the current circumstances. RJ, are you ready to go?
I am. Thank you. Can everyone see the screen?
You're up, sir.
Right, great. Good afternoon, everyone. Thanks for joining us. So I thought we would provide just a brief overview of how we see the economy and the investing landscape in this post-monetary tightening cycle environment. So before we get into that, I thought a recap of the major asset class performance year to date would be beneficial just to set the stage and provide context. All of these returns are through September 9th and in Canadian dollars. So they're for us Canucks here as we translate these returns to our home currency. Leading the way is gold, up an impressive 24% year to date. The movers and drivers of gold are quite apparent. Lower inflation, geopolitical risk, demand for gold in many industrial heavy economies. And next is U.S. equities and global equities. Now, they are obviously quite distinct, but they are driven by the same thing, and that is U.S. technology. The global equity indices, here the MSCI World Index, obviously has a very large exposure to U.S. technology. So you'll see them up 17.5% and 15% respectively. And the picture becomes quite clear how technology is really in charge of the markets when you look beyond the U.S. to other regions. For example, Canadian equities up only 11. Asia Pacific equities up only 11. Canadian REITs, European equities, again, up around 8%. So really the story continues to be US technology, led by the so-called Magnificent Seven, Microsoft, NVIDIA, Alphabet, Meta, etc. These are the real powers, the stalking horses of this market. Commodities, interestingly, while gold is up 24%, a broad-based commodity basket is actually down year to date. And that's the Bloomberg Commodity Index down there at the bottom. And that's a broader commodity index comprised of oil, natural gas, base metals, agricultural commodities. And that is really telling us a lot about where the global economy is right now. If we go to the next screen here, you can see really we're just muddling along. We had this great surge post-lockdown. And then in 2023, several economies actually experienced technical recessions. Germany, UK, Finland, Japan, really the whole Eurozone went into a technical recession in 2023. And I would actually include Canada in that group. Canada did not experience a technical recession. We had a negative quarter and then basically zero. So I'm going to put that in the recession camp. But really, if you just find a recession as a general slowdown in economic activity and a rise in unemployment, that really is an apt description of the current global economic landscape. And we don't really see anything in the data that would suggest that growth is going to come back. Nothing in the data from a top-down perspective or from any of the companies that we follow closely. None of them are really saying, you know what, the second half of 2024 is looking really robust, or we're really excited about 2025. The companies are cautious. They see some bumps in the road here. And, here's the consensus and in these two columns here for really the economic drivers of the world here. And you can see it's 1 to 2% real GDP growth. That's the consensus for the next 2 years. So, there's nothing a whole lot to get excited about from a top-down perspective. There are some bright spots in the world. I would include Spain, France, several countries in South America, Singapore, Vietnam, where their treasury markets and their inflation and unemployment continues to signal some pretty strong performance ahead. But really, by and large, it is just a murky environment. That's how I would describe it. And I mentioned we follow many companies closely. Either we own these companies on behalf of our clients as shareholders, or we're hoping to buy them one day when they fall down to our price targets. And as we review their earnings calls, as we review what they're saying at industry conferences, as I said, they're not saying anything terribly optimistic. In fact, I would say things have gotten worse in the last couple months. You can look at Dollar General, which just reported earnings and the stock plummeted 30%. They're saying that their customers are feeling worse off financially than 6 months ago. And one stunning stat I read on their call was that 30% of their customers have at least one credit card that's reached its limit. Amazon, on the retail side, obviously Amazon has many lines of business, but in the retail side, the retail, Amazon.com website that we all, I'm sure, use, what they're seeing is that consumers are being very, very careful. They're trading down. They're looking for lower priced goods. They're looking for deals more than ever. And then just this week, Ally Financial sent shockwaves through the financial markets when they raised a few alarm bells about recent trends on the auto lending side. As the CFO Russell Hutchinson said, you know, credit challenges are intensifying. There's cohort of borrowers are out there that are struggling with cost of living, and they're now struggling with an employment picture that continues to get worse. And delinquencies are on the rise. BMW just gave a warning about its outlook, saying that, you know, we have far too many cars out there. We've kind of gone through this post-COVID normalization, and customers are just not buying as many vehicles as they used to. So dealer lots are now full of excess inventory. And as the Dollar General and the Ally financial executive said, you know, here's the picture. In 2022, the U.S. Federal Reserve and the Canadian Federal Reserve both started to hike interest rates, and you can see that since then, the unemployment rate here and south of the border has continued to steadily rise. In Canada, we're now above 6.5%. The U.S. has now poked above 4%. Now, 4% is not terrible. In fact, that's kind of the level we were at pre-COVID. But as we know, economics is really all about the rate of change versus the absolute levels. So when you go from a 3.5% to 4%, and now perhaps 4.5%, that's a very, very drastic change in the employment landscape in the United States. This is something we've been following closely. This is the Conference Board's leading economic index, and it's comprised of several variables that are designed to give you know, a little bit of a insight into where the economy may be heading. So in this index, there is stock prices, there's layoff intentions, manufacturing purchasing orders, there's the stock market itself, there's credit spreads. You know, all these variables are leading the economy, whereas unemployment is, you know, what's happening now. These are supposed to, you know, give an insight to what could be around the corner. As you can see, the Conference Board's LEI, the leading economic index, has deteriorated now virtually every month for the past 2 years. It's pretty incredible. And again, we don't see any sign that this is going to have any sort of rebound over the next 6 to 12 months. It's not all bad, though. Corporate efficiency continues to astound us. More than ever, companies have just real-time data on customer actions, customer intentions, and they're able to pull levers and respond to what's happening almost in real time. We were reading the Disney earnings call, and a question came from an analyst about how they're going to respond to an economic slowdown, and they remarked that they have more data than they ever had in their history, and they're able to dynamically tweak concession prices, ticket prices, you know, merchandise prices, almost in real time in response to changing customer behavior. And also technology, artificial intelligence, as we know, is really starting to drive corporate productivity. So even as demand from consumers is reined in, or consumers are just more cautious, they're able to respond very quickly with cost cuts and other levers to, you know, shore up free cash flow. Earnings, and as such, earnings are more or less delivering. The high-end consumer is still very strong. If you look at a stock chart of Ferrari versus Dollar General, they're completely opposite. Luxury goods domestically, and Europe is still, you know, somewhat stable. In China, that's a different story. Inflation has been tamed, and now we are at the beginning of interest rate cut cycle. And the banking system is more or less sound, unlike in 2008. You know, we've gone through stress tests. You know, we know a lot more. We have a lot more credit data at our fingertips now. The Canadian banks in particular are well capitalized. So we're not too concerned about that. And that's really pushing against what I was talking about in the previous slides, the weak consumer, the rising delinquencies, the slowdown in China. Another risk I would say is just equity markets in general don't offer a lot of risk reward. There's, you know, the rising unemployment, record government debt. So really it's just this push and pull. And that's why I would define the overall landscape as murky. And so we're in this murky time. And what we're doing is we're sticking to the basics, blocking and tackling. We're looking for companies, strong moats. So they have either, you know, you think of a company where, you know, it's a subscription-based business. They have a strong brand name. They offer, either it could be clothing or just a beauty product, something that is going to do well, really no matter the economic environment. They have strong financials. They have cash on the balance sheet. If they do have debt, they don't have any rolling over in the next year or two while interest rates are high. They have strong free cash flow, high profitability, and they're undervalued. They have that risk reward, that we're looking for. They're not in the more aggressive kind of growth areas, technology. We're looking elsewhere, and I'll let Badar speak to that. So, these companies can power through no matter how murky the economic environment happens to be. And that's really what we're looking for. So I'm going to pass it over to Badar, and he can speak to the implications of all of this for portfolio construction.
Okay, thank you, RJ, for that broad overview. So RJ did a pretty good job sharing a lot of data points that we're seeing that are pointing to a softening economy here at home, as well as in a number of major economies around the world. All of that also kind of, quite frankly, comes into play from a chamber's perspective as we have been dealing with murky waters in geoeconomy and trying to rejig our supply chains, specifically trying to address the huge trade imbalance we've been dealing with here in Canada and the United States, as well as amongst other G7 nations with China. So I'm going to try to put that in very simplistic terms in terms of what that means to an average investor, an average Brampton Board of Trade member that is looking at all of this and trying to figure out how best to manage their own financial affairs. People tend to have different investment experience, and along with that different investment experience, they also tend to have different risk profiles, which is quite frankly categorized by the amount of assets they have, as well as their personal propensity to take a certain amount of risk. But irrespective of all of that, I think we will all tend to agree that, as you start your day in the morning, you're still going to start your day by turning the electricity on and paying somebody for that utility bill. That falls in the staples category. You will go on to have breakfast. There are, again, staple companies out there that are providing that food that you're serving yourself, as well as other loved ones in your family. As you leave your house, hopefully somebody helped you build that house, as well as there are a number of large real estate companies in our communities that quite frankly provide essential services to us in the form of shopping plazas, as well as rental accommodations. Jaipal, a number of them are our chamber's members as well. And so basically there are sectors and there are companies that all of us use on a day-to-day basis. And as we use their services and their products, we inadvertently also continue to contribute towards their revenue and their profitability. And while the revenue and the profitability stream under the circumstances might be flat, if the company is a well-run company and they have a significant market share, then irrespective of whether I am a young person and I have a long-term time horizon to invest, or whether I am somebody who's nearing retirement or is retired, I can rely on those businesses to hold in my investment portfolio, both from the standpoint of generating revenue and out of that revenue paying me a certain amount of income or dividends, while I wait for the overall macroeconomic conditions to improve as the central banks here in Canada, United States, as well as around the world, continue to now recapitalize the economies by bringing the cost of borrowing down. So we're certainly finding a lot of undervalued companies, as RJ mentioned. If you take a look at RJ, can I ask you to move to the next slide for a second? Oh, sorry. Can you go to the slide after this? The last slide, this one. Yeah, exactly. As RJ mentioned, the growth in the global capital markets have really come from a handful of technology names, and so what we're finding as professionals is that there's quite a bit of value gap between the valuation represented by companies in those high-flying growth tech names, which is reflected here by the top line, versus what you're seeing at the bottom line here, which are very well-run companies, but not necessarily in the high-flying tech sector. So as money managers, we're, sorry, RJ, I'm going to ask you to go back to the sector slide. Yeah, thank you. As money managers, basically, we're trying to give exposure to our clients to diversified sectors by finding those undervalued companies that are largest shareholders in their respective businesses. And because of their dominance, either man-made or natural advantages, they're able to sustain their profitability and revenue streams as the overall economy goes through this softer patch before it starts to regain growth. And from a tactical perspective, from even the younger investors would do well in a time like this to have more exposure to these kind of names rather than being more risk takers for the time being. RJ, if I can ask you to go to the next stage. So basically, this is our team case for how investors, whether they're Brampton Board of Trade members or not, should consider constructing their investment portfolios from a short-term perspective. All of this should be reviewed on an ongoing basis between an investor and their advisor. If you don't have an advisor and you would like to get an opinion, or if you have an advisor and want to get a second opinion, I would be happy to sit down with you and go over it and show you how we would customize an investment solution for you. But in a nutshell, if you can focus on equities that are not overly priced and are fairly valued, in other words, the share price reflects the underlying fair market value of the business, as we wait for the interest rates to go down and those companies to benefit from the increase in consumer spending as well as corporate spending in coming years ahead, those companies will perform well for you. You could do that by either lending to those companies if you're a more conservative investor, because lenders do tend to stand ahead of shareholders from a risk perspective. As a result of it, they also don't tend to make as much money over the long run. But if you're a conservative investor, one way to do it would be to either buy bonds, or if you're a large enough investor, perhaps lend money as a private lender, as an accredited investor to some of those companies. The two sectors where we're seeing a lot of undervalued companies, obviously, are real estate investment trusts and utilities. Utilities, simply because as high-flying tech sector did well, a lot of money moved from utilities over to the tech sector, not necessarily because that was in line with the client's risk profile or investment profile, but simply because, market investors generally tend to follow what is hot and the flavor of the month. REITs in general and real estate in general is simply undervalued because interest rates have gone up over the last 2 years. And as the economy stays cool, people are still weighing their options, waiting for cost of borrowing to come down to manage their cash flow and then get back into real estate as an investment vehicle. Same is true for large real estate investment trust as well, except that, again, some of those large investment trusts are either renting their properties to A-grade tenants on the commercial side, and those A-grade tenants are in a position where they can consistently pay the rents, even if there was a small increase on an annual basis. Or they are taking, in many cases in commercial real estate investment space, they're taking their footprint and they're coupling their commercial footprint by building multi-purpose residential real estate properties. In which case, they're now also addressing the shortage that we have here in Ontario and elsewhere in North America and around the world in large metro regions of low-cost real estate. So we believe that the timing of the market is such that any investor, irrespective of their age group, and especially those who are near retirement or going into a retirement phase, will most certainly benefit by having exposure to investment-grade bonds, and also diversifying into either high-yield bonds or REITs, or adding some dividend-paying companies in a diversified manner to their portfolio. Next slide again, and yeah, so I think I've already covered the graph part. So so in summary, focus on companies that have either man-made or natural competitive advantage, or a catalyst that will allow them to continue to do well and recover well as the markets get recapitalized by central banks. And we're finding undervalued companies in healthcare, staples, and other non-tech related sectors. And in general, we're favoring income over equities, because if you're holding older bonds paying current yields or higher yields, as interest rates will go down, not only will you continue to gain that income, but you will also see some appreciation of the value of those bonds. And the same is true for other income generating assets. That's it for my part, and I'll hand it back to RJ to introduce Jai.
Vidar, if I may ask a question just before we get into the next sort of phases, based on
Sure, absolutely.
some of the information that you and RJ provide. I think this is some really insightful stuff here, and I'm trying to bring it forward. I know you have some very experienced folks who you advise, but there's also some folks who are novices in their understanding of economic forces. I'd probably count myself among them. So perhaps I'm asking a question on behalf not just of myself, but others as well. Both you and RJ had laid out really, where the trends are right now and some strategies and advice that you would give based on those trends. Help us understand a little bit, how volatile are things out there right now? Are the trends you're seeing and the advice you're giving, is this advice that you foresee for the next quarter? Is this the advice for the next half a year or a year? How reactive and responsive do you anticipate investors need to be?
So quite frankly, on the professional money management side, we follow the markets on a daily basis. Having said that, when you're giving advice, you never tend to pretend that you can predict short-term trends perfectly. And so we always ask our investor clients to take a bit of a longer-term approach. So when we say that in the short run, we consider markets to stay soft, for all intensive purposes, it seems that the central banks are targeting inflation to come down to their target rates by the end of 2025. Hopefully, worst case scenario, first quarter of 2026. And so if the interest rates at that point in time are hovering around 3%, 3.25%, hopefully that will help recapitalize some of the softness in the market by getting the real estate market going, as well as some of the other spending going, especially in the low-income consumer band. But I would ask any investor as they sit down and review their asset allocation, as we call it, with their advisor, to irrespective of how experienced the advisor is. I mean, I've been in this business for 24 years, Jai Paul, and there are a lot of other very experienced advisors out there, but I don't think any one of us can predict, quite frankly, what will be the next steps for Russia, Iran, or China in the geopolitical theater over the next quarter to 2 quarters, and how that might impact the supply of oil, how that would impact inflation, and what the next steps would be the central bank given those changing dynamics. So anything can happen in the short run. It is an unusual environment that we're currently operating in, with us not just fighting the monetary and fiscal issues, but also dealing with some broader geopolitical issues that I think we need to be cognizant around.
No, very much appreciate that. And that's some great insight there. If I can ask one more question that again speaks to some of these global pieces out there, but maybe less volatile, less geopolitical, but more so about markets. RJ started off his component, really talking about where you're seeing the growth, where the trends are right now. And RJ, you highlighted that sort of that foundational piece that the U.S. technology sector was playing in the global economy. And that all makes sense right now. But we also understand, based on changes in access to technology, the more democratization of technology, chip technology, starting to become something that Asian markets and China are getting more actively involved in. How do you see some of the geopolitical pieces, strife and otherwise aside, some of these other economies as they emerge as technology players? Do you see that changing how you laid out that foundational component of the conversation, RJ?
Not really. And really that's because it's been like this for a long time. The new component to this is artificial intelligence. However, the world has always been bifurcated and split really between the Western internet and what you call it, the Eastern internet. China, the Chinese technology environment, what Tencent, Alibaba, JD, they're quite different than the U.S. Their U.S. counterparts. They don't really interact. For all intents and purposes, it's two different worlds that are doing their own thing. And so before, it was really more about commerce, about selling goods and services. It was also about cybersecurity. That was a very big issue. And also IP, right? Intellectual property, how China obtains intellectual property. But now really we've shifted to artificial intelligence, the ramifications of sharing chip designs, software design to China. And then the military implications of that. However, it doesn't really change what we're doing necessarily on a day-to-day basis. Just to springboard off your previous question, really it's our primary job is understand the client's risk, understand their objectives. That drives the asset allocation, i.e. income, equities, other asset classes that we have, private investments, and then the allocations within those asset allocations. So within the equities, we're sticking to utilities and real estate, financials, staples. So on a day-to-day basis, what's happening with artificial intelligence and the onshoring, the trying to onshore with Intel and Taiwan Semiconductor in the United States, the security implications of that. That's all very fascinating, and there are huge implications. But on a day-to-day basis, it does not really affect our investments. In even in technology, right? We don't own any of the Magnificent Seven, but we recently, we've owned Microsoft, we've owned Amazon, and there are a lot of geopolitical angles there, but it does not really affect their business, the business valuations.
Appreciate that. No, thank you for expanding on that for me, and just quite frankly reaffirming why individuals like myself need to be talking to individuals like yourselves to help make these decisions and figure out those strategies. So I appreciate you entertaining a couple of questions along the way. I'll turn it back over to you, RJ.
Oh yeah, so thank you for that. And now I'm going to pass it over to Jai, who is going to talk about some financing strategies for Canadian mid-market businesses in the year ahead.
Thanks, RJ. Jai Paul. So while RJ and Badar has focused on investing capital on behalf of individuals and families into public markets, within my group, our focus is really to assist Canadian mid-market companies, primarily private companies, to access capital for growth, acquisition, working capital, or recapitalization. And when we speak to businesses which would be similar to many of the Board of Trade's constituents, these are just some of the feedback we're getting today, given the environment that we're facing. So a lot of entrepreneurs say to us that, the biggest challenge for them is really being selective in the projects that they choose to move forward within this environment because of the high cost of capital. Inflation continues to be a worry for a lot of entrepreneurs, and finding appropriate capital is really the bigger issue for a lot of folks. RJ touched on technology and AI. We're seeing a lot of companies really look at how they can utilize that part of new technology to bring efficiencies to their own businesses, while they have to battle with other operational challenges such as supply chain and global competition, and so on. Within the Southern Ontario or even the Canadian market, we're still seeing companies pursue opportunities where they can, even with higher cost of capital, they're selective, but they're still pursuing opportunities where they can bring efficiencies to their business. Ajay, can I move over to the next slide? Thank you. So where are they finding the capital? For the last few years, we've seen a shift away from depending on traditional banks and relying on family offices and private providers. We feel that that's still the opportunity today, as private providers allow for greater customization, often provide better leverage in the case of acquisitions or project financing. And they can often be open to being flexible on repayment terms, whether it's providing an interest reserve or interest-only window with some kind of a balloon payment at the back, or different structures. And we feel that this today, given the high cost of capital, this is really the primary mechanism to scale. Looking to access private capital to do those acquisitions or to bring technology enhancements to your business. So where are entrepreneurs really looking to utilize capital? I think the really critical focus is finding the match, finding the providers that will align with their internal corporate goals and long-term objectives. So whether it's stabilizing a business for succession or growing the business. Today, I think that there are a lot of entrepreneurs that has to start thinking, they have to start thinking about succession. And we're seeing more and more situations where entrepreneurs are using this slower environment as a way to restructure, refocus their business in a way to enhance the value as this cycle turns around. It'll give them an opportunity to exit. Next slide. So this is really where private capital gets really interesting. Today, we don't see as much activity from traditional capital providers, particularly in acquisition financing. For example, in the past, we used to see banks being open to providing a higher loan to value. Today, many of the deals that we see, it's often situations where the buyer businesses or private buyers, sponsors have to put up almost half of the capital required for the deal as equity and maybe get access to bank financing or traditional financing for the other half. Private capital can be more flexible. And so you have opportunities where private capital providers will in some ways be able to provide different types of capital on the stack and bring your loan to value to higher levels. And that really helps in this environment. Working capital is a challenge. For companies that are facing slower growth, getting access to working capital from traditional sources becomes a real challenge. Again, this is where the flexibility of some of the family offices or private capital providers can be really interesting. One of the areas that we're seeing an increase interest in is really trying to find strategic partners. These are not just capital providers. These might be companies within your segment, whether it's suppliers or customers that see an avenue where it makes sense to come together and provide some kind of stabilization strategy for both companies, let's say. So we're seeing more and more of that because in this environment right now. So one of the things that we've noticed in the last 6 months as the Bank of Canada is starting to lower rates, businesses aren't seeing the impact of this. A lot of it's trailing. It's unlikely that a lot of this, the rate decrease cycle will impact your everyday businesses for the next 6 to 12 months. And so some of these companies have the opportunity to go out and acquire their competitors that are not being well managed, or they're not able to access capital. So if you're in a situation where you have a stronger balance sheet and there's a weak competitor that's not able to access capital, this is the environment where we're starting to see transactions where consolidation can occur in certain segments. The stronger balance sheet wins in this environment. As RJ and Badar pointed out too, even when we're looking for companies to invest in, we look for the companies that can endure in this type of environment. Well, it's the same thing with companies that are operating in this environment. It gives them that sort of real edge if they have a competitive position or they have a stronger balance sheet, that they can go out and acquire the weaker players in this environment. So our team really were able to bring access to institutional capital providers. These are pension funds, often insurance companies, or private credit funds. And we've seen a real drive and pickup in companies moving towards this part of the spectrum to access capital in the last few years. And we think that this will continue into the next part of this cycle. So we're able to help companies to access senior secured funding, mezzanine capital. We're able to help them structure offerings, whether it's a convertible debt note or private placement through equity placements. Thank you. That's it for us.
That's amazing. Thanks, Jai. And I appreciate those insights there. And in particular, the comments there around access to capital in non-traditional sources, the flexibility in structures, the strategic alignments. I'm sure people are very interested in learning more about this. I kind of know where the answer is going, obviously, how PD Generation can be involved in this conversation, but help me understand, if I'm a business looking to access some of these non-traditional, perhaps is the right term, access to capital, what is it you at Generation are looking for? What do I need to bring to the table to get that conversation going with you to help get to that next level and explore these types of options?
I think one of the biggest challenges for companies when they go out seeking capital for growth or acquisition is really knowing who the other parties are, who has available capital. And I think that's one of the edge that we bring. We have intelligence in the space. We're constantly speaking to capital providers. And so we have an understanding of who has liquidity, who doesn't have liquidity, what sort of sectors align with their capital, and what opportunities they're looking for. And I feel that for a corporate entity just going out, calling on every institution out there, it's not very effective, simply because you don't know whether they have capital or whether they will align with your business. And that's really the edge that we're able to bring to the table. The other part of this discussion too is, so once you've found the provider that aligns, is it just a matter of you sort of presenting your balance sheet to them and they're on board? And it's never that easy. So there is a fair bit of preparation and structuring that has to be done in order for you to attract those investors. And that's really another part of what we're able to help with, to help in preparing the business. And it may take time. Sometimes it's just a matter of streamlining your own financial reporting, or maybe changing the way you present financial reporting to align with what is required by those capital providers, as an example.
And then as it pertains to those capital, those types of investors out there who have this capital, whether it be in the form of family office or whether it be in the form of private equity, help me understand, are there trends that they themselves are looking to invest in right now? You've got your ear to the ground. What types of opportunities are your investors looking for that those in the business community should be excited about, or might perk the ears of someone who might be on this conversation?
So there has been this real move towards looking for businesses that are more stable, cash flowing. I think lenders, just like individual investors, are also looking for security of their capital in this environment. And so the companies that are getting funded easier are companies that have a better track record, have a history of good management, and they can demonstrate that they're able to really utilize capital in a way that's efficient, and the lenders have a secure position. For private equity groups, it is really a very different discussion, because often private equity groups are looking for specific opportunities. It might be a situation where they have an existing platform company that gives them exposure to a certain segment, and they're looking to grow that company. So they're looking for similar businesses that could be a complement to their existing exposures. So very different when you're looking for an equity investor or a debt investor. That's also something that entrepreneurs aren't always keen or able to distinguish between the two. The discussions are very different, the presentations are very different, and what those investors are looking for is often very different.
No, I appreciate that. And once again, sort of to the previous set of questions I asked, I really appreciate the insight, because it just reaffirms once again, although, some of these strategies are sensical, and when one thinks about them, you're just highlighting again why you need the opportunity to talk to people who are experts, who have the networks, who have the data, and have the experience, quite frankly, to guide one through the process in the manner that Generation does. So I appreciate you highlighting that for us.
If I may
please,
just
Bedar.
add one quick thing to that. So in case of family offices, or in case of accredited investors, your members would be able to relate to this quite well. If you have created your wealth, or if you have generated your wealth running a certain type of business in a certain sector, naturally you tend to know a lot about your own sector.
Yeah.
And from a next steps perspective, you're always looking out to either hire talent that can basically help you build a complementary segment to your own business, or looking at investing in a startup out there that complements your business and would allow you to actually add another vertical to it, or complement your own business. So even small to medium-sized business owners who have done well running a business. So for instance, in trucking, Brampton has a very large logistics sector, and a lot of trucking businesses would be on the lookout for technologies that augment what they have been doing traditionally in their trucking business, whether it's last mile alternatives, or whether it's coming up with better technology in terms of incorporating GPS tracking of your logistics and all of that good stuff, right? So even small to medium-sized businesses who have done well and are accredited investors could be provider of capital to other small to medium-sized businesses as long as they can see a value add to their existing business.
No, it makes tons of sense. And I appreciate you highlighting in that way, because I think when we have these types of conversations about the acquisition of technology in order to enhance one's core business or to give one a competitive edge, we often see the headlines. And those are usually the large tech players, the ones you refer to as the Magnificent Seven, buying up other apps or buying up their competitors. But you're right, traditional businesses and those of us who are maybe in the small and medium business size sector can still employ those same strategies to create those competitive advantages for us as well. So I appreciate you bringing that to light.
Yeah, I mean, we are in finances, and I can tell you, even as a professional investor, I tend to pay a lot of attention to what's happening in fintech space, precisely for that reason. I'm always on the lookout for what's coming up, either in the artificial intelligence space or other complementary tech businesses that perhaps we're not currently looking at, and might allow us as a firm to complement our solutions, or down the road might be a good acquisition, right?
No, fantastic. You're giving us all sorts of nuggets here, Badar. I appreciate it. Just as we're coming up on time, we've talked about the macro trends. We've talked about some investment strategies, both for experienced and novice investors. We've talked about how to access capital in order to support innovation and business growth. Is there anything else that we want to touch on, or anything else, last sort of perspective that you'd like to share with those who are with us today, just to give them the benefit of your insight, or to encourage them to connect with the team at Generation to learn more?
The only other thing I would add is that, quite frankly, there's still a lot of need for us to do a better job in terms of financial literacy. And that applies not just to investors in terms of understanding the differences between all the different retail investment solutions that are available versus investment counseling solutions that are available through firms like ours. But it has implications in terms of cost of investing. And in an environment like this, where bottom line matters for investors and cost savings matter, get to know your investment advisor, find out how they're compensated. In our case, we work on a flat management fee basis. In non-registered investment accounts, that fee is tax deductible. And so in addition to you getting advice on creating a customized investment portfolio, you're also benefiting by reducing the cost of money management by taking advantage of that tax deductibility that us professional portfolio managers can offer. And that's about it. I don't know if RJ or Jai might want to add anything else to it.
No, Jai-Paul, your question about how do people just get started really struck a chord with me. And I would encourage, we often think of this as like a business, but really as members of the community, I would like to put it out there that if anyone has basic questions about how do I even start, or on Jai's side with business formation and capital raising, or on our side with investment management, just reach out, get the conversation started. There's no, as community members, we feel that, it's our obligation to help BBOT members, to help people in the community. We all do, lots of charity work, financial literacy. So the more knowledge that we can help get out there with no ROI expectation, that's part of our ethos here. So, just pick up the phone and get the conversation started with someone.
That's great. So any last comments from you there as well?
Yeah, sorry, Jai-Paul. I was just gonna say that's such an interesting thing that RJ touched on, because at every Board of Trade event that Badar and I go out to, we end up bumping into people, or just jumping into conversations around, how do they sort of do certain things, whether it's accessing capital or plan for succession or what have you. I think that the entrepreneurs often live in a very small sort of space around them, their own business. And it's often really interesting where if they have sort of a plan in mind, there are people, like, it's easy to have a conversation with us as a sounding board to explore some of those ideas.
Yeah, greatly appreciated. And so for all the insights today, and also some of those final comments around financial literacy and others, I think you've given us the jumping off points for the next one of these conversations we'll organize with you. And appreciate the plugs there. What we'll put in the notes that accompany this when we post it is contact information so individuals can reach out to the team at Generation. But as Jai highlighted there, they are fixtures at Board of Trade events, and all you need to do is come out and spend time with us, and you'll end up spending time with them as well. So with that said, RJ, Badar, Jai, thank you so much for all your insights today. They were fantastic. I'm trust that anyone who's watching this has learned a lot and will follow up. And finally, as well, thank you once again to PDC, the sponsor that helped make today's conversation happen. We trust it was insightful for everyone, and look forward to the next one of these very, very soon. Thank you very much for joining us.
Thank you.
Thank you.
Bye, folks. Bye, folks.